Hi, Terry. I thought it was worthwhile having a chat because I know that we're both dealing with requests for advice from clients on their ability to claim in respect of business interruption arising out of COVID-19 situation. We're in a situation where, unlike the more day-to-day claims that are arising, like from flooding or from fire on premises or neighboring premises, in the past 20 years or so, there's been a huge amount of other cases arising from major world events like the tsunami and the SARS outbreak in Asia, Hurricane Katrina in the States, New Zealand earthquake, and now COVID-19 across the world.
Yes, now that everyone is turning to examine the question of business interruption, it's worth noting that coverage may be contained in a policy only dealing with business interruption, or it may be an add-on to a policy dealing with damage to property and all risks. And that may pose issues in construction as to whether coverage includes business interruption, which is not linked to physical damage. And so I think we should consider three issues, really: whether the claim in question is covered by the wording of the policy, how much is the insurer liable to pay, and the question of causation.
Yeah, those are certainly the issues that are cropping up in the cases I'm dealing with. Let's deal with coverage first, if we may. That's generally, but not always, going to require the insured to establish the existence of an insured peril or risk under the policy of the existence of an infectious or contagious disease, so far as COVID-19 is concerned. But that's not always the case, because even if infectious or contagious disease is not expressly an insured peril, there can be circumstances in which, depending on the precise policy wording, the insured may be able to recover if the policy covers loss of attraction, for example, or prevention of access to premises.
Yes. Well, there are about 1 million policies in the market in the moment which are extant and which may merit consideration. I think the starting point, and I don't think there's much point us discussing it for very long, is that these policies have to be construed according to ordinary commercial principles. Though the interpretation is absolutely straightforward, the principles of that are straightforward, but their application may be difficult because the policies are not always particularly well worded. And the rubric is to remember that you're looking at them objectively, not at what the insured thinks he would have wanted the policy to say. And also one must remember that contra proferentum rule is rarely a rule of last resort.
Yes, and on burden of proof, it's going to be for the insured, of course, to prove the existence of an insured peril or that the claim's covered. Then it's going to be for the insurer to show that any relevant exclusion is applicable. And if there happens to be a proviso to that exclusion, the burden is going to shift back to the insured to bring himself within that proviso. Against that background, I mean, let's look now at the second aspect, which is important for both parties to a policy, which is how much is the insurer potentially going to be liable to pay. And that's a difficult area, which requires expert forensic accountancy evidence, possibly market evidence. And the starting point, again, is the wording of the policy. In this instance, it's going to be the loss settlement clause, where one sees different formulae for the calculation of loss in different policies. For example, the date for the calculation of loss is usually going to start on the date of the occurrence of the peril insured against. And there may be excess periods, typically of 90 days, but not invariably, before any loss becomes recoverable.
Yes, and the factor against which you measure the loss is expressed differently in the various policies. Some of them are loss of profit to be measured by reference to the profit which the business made in the preceding 12 months leading up to the inception of the policy. It may be limited to debt incurred through the interruption. May require, and probably does require, loss avoided through the interruption to be taken into account. And of course, as you say, there's an indemnity period to consider. And the other issue is, was the business going to do well or was it doing badly anyway? That's the trend issue. that's another factor that will require expert evidence.
Yes, in general, of course, losses that are made after the end of the indemnity period won't be relevant, but they could well come into play if we're dealing with a trend clause that you just mentioned. And in the rare event that a loss can be made up within the indemnity period, that's also something that's going to have to be taken into account.
Yes, and it's just worth noting that you've got to go by what the policy that you're looking at provides. There's very little authority on these policies, because whoever is looking at it, an arbitrator, which is, the decision's often private, in court, it's geared to the policy in front of the court.
Yes, and there, for that reason, arbitration, there aren't that many court decisions that bear on the issue, which doesn't make the giving advice any easier. There is the Hong Kong Court of Final Appeals decision in New World Harbour View Hotel case, which concerned the SARS epidemic and whether losses were confined to losses from compulsorily notifiable disease pursuant to statute. And that's a case well worth looking at in the context of the situation that's arising at the moment. So that, I think, brings us on to the third of the issues, the important issue of causation, which is always at the end a question of fact. But even if the interruption to the insured's business is due to an insured peril, the insured's only going to be entitled to recover if the interruption was caused by that peril. And again, depending on the policy wording, there's plenty of room for insurers here to argue that the business interruption in question wasn't so caused.
Yes, and that raises the issue of dual cause, which is always an interesting topic. It may well be that in certain cases there were two reasons why the business was interrupted. It could be business regulation, which may not have been government regulation, may not have required closure. The virus may have been mentioned, or it could be the other way around. But the general view is that provided one of the causes specified in the policy operates, you should be able to recover.
Yes. So I think what we have to think about what the takeaway is from the situation that we're in at the moment. I mean, I would make three brief points. Firstly, don't assume that because the policy refers to the need for damage, that a claim for business interruption resulting from COVID-19 will automatically be excluded. The second point is that don't assume that because the policy doesn't expressly identify notifiable or contagious disease as an insured peril, that a claim for business interruption resulting from COVID-19 will necessarily be excluded. And one shouldn't also ignore the possibility of a claim against the broker for not having procured the cover which the insured had asked him to obtain.
Yes, and some of these issues are may be resolved by the Financial Conduct Authority's case, which it's bringing on certain selected policies. But it's likely that whatever the rulings in those cases are, they're going to leave a whole lot of points open that the judge can't deal with, and other policies may or may not be affected by the ruling.
Yeah, I agree. I certainly don't think the FCA judgments that come out are going to resolve all of the issues that are arising, or they may give some guidance in particular instances. Anyway, useful to talk to you, Terry.
Very nice to talk to you.
Nice to see you. Take care.
Bye.
Bye-bye.